Hello, good evening. Welcome back to our class once again. I would like to welcome you back and thanks to everyone that watched the last video and also um, subscribed to my channel. Please feel free to click on the subscribe button. I would really appreciate if you can help in subscribing so that you can also get notification every time I drop in a new video. Thank you. Please share the video. If you have any question, please drop it under the comment section. If you have any comment as well, just put down your comment at the comment section. Yeah, that will be very, very helpful. Yeah. So today we are going to be looking at income taxes, IAS 12. Um, and it is worth noting that this particular standard is for both the professional student and as well as the scale student. That's for corporate reporting and financial reporting in ICAN syllabus. So do well to share with your friends that are writing both corporate reporting and financial reporting. Yeah, income taxes is one of the standard that will be tested. That can be tested. Let me put it that way. I'm not a magician, so I don't know if it's going to be tested in the current diet. So basically, we'll be looking at income taxes and two major things about income taxes. One is the current tax, and two is the deferred tax. And it's worth noting that most of the questions that come around the current tax is always, sorry, most questions that comes around IS 12 is more of deferred tax because current tax doesn't really have any technicality in it. So it's worth noting that we'll be focusing more on deferred tax in this class. So our priority is to ensure that we clear the hair on things around deferred tax. So just go along with me. Basically, we'll be looking at the terminology. Two, we'll be looking at how to arrive at the tax base of an asset or a liability. When does a temporary difference lead to deductible temporary difference or taxable temporary difference? That's one. Then what leads to deferred tax asset? What leads to deferred tax liability? Then we'll also look at when to recognize deferred tax asset. Is it in all cases that you recognize deferred tax asset? Then as well, it is also important that you understand the impact of revaluation and impairment of property, plant, and equipment in terms of income taxes. So we're going to be looking at all these as fast as possible. Yeah. So just carry along with me as we move on. So, like I said, I'm going to start with the terminology. And the first thing I'll be looking at is what is the temporary difference? What is temporary difference? That's the first thing I'm going to look at. Allow me to put the abbreviation TD so that when I say TD, you understand that that's temporary difference. So the first thing is, what's temporary difference? What leads to temporary difference? Now, temporary difference is the difference between the carrying amount of an asset or a liability, right? And is the difference between the carrying amount of an asset or a liability and the tax base of an asset or liability. Now, this difference usually arises as a result of timing difference. What do I mean by timing difference? We're saying that, oh, a particular person treats a particular transaction at a particular period, while the other particular person treats this same transaction at another particular period. Now, a typical example of what I can use as a temporary difference is when you have capital allowance, and depreciation. Now, these two, it is very, very important. Let me just use this as an example. Now, the taxman use the capital allowance. Why? From an accounting point of view, depreciation is used. An asset that is bought for 5,000 naira, right, will be depreciated, let's say on a straight line basis for 5 years, right? Which means that this 5 years, for per year, year 1 to year 5, the company, the accountant, from accounting point of view, will be charging what? Will be charging 1,000 as depreciation. Now, for capital allowance, based on the jurisdiction where we are, which is Nigeria, let's take, for example, we have what is known as initial allowance and annual allowance. Now, the capital allowance, with your initial allowance, let's say you have 10% initial allowance and 15%, um, sorry, 10% initial allowance and 20%. Let me use that just to make it a bit simple for us. 20%, 20% for annual allowance. Now, it means that in year 1, the taxman is going to have what? An annual initial allowance of 500. Still in year 1, we have the annual allowance of the balance, which is 500 minus, sorry, 5,000 minus 500 and times 20%. So I'm going to use my calculator, so which is 4,005 times 0.2, which is going to give us 900. In the first year, it's going to have what? It's going to have 1,400. Now, what is going to be the carrying amount? The tax written down value at this point is going to be what? It's going to be 5,000 less 1,004, right? 5,000 less 1,004, which is going to give us 3,600. Now, from the accounting point of view, you are still going to be having what? 4,000 as the carrying amount. Now, it is simple. There's a temporary difference of what? Of 4,000 minus 600, which is what? 400 naira. Take note of this. This is a typical example of what's it called? Taxable. Sorry, this is a typical example of a timing difference or a temporary difference. Please take note of this. Now, what has happened? The taxman is seeing it from a different perspective. From an accounting point of view, it is seen from a different perspective. Now, the reason for this difference is what we now term as what? As a temporary difference. Now, if the taxman, now, okay, let me go back a bit. Why is it even a temporary difference? It is a temporary difference because at the end of the day, everybody will have both the tax written down value and the carrying amount of the asset is going to nil off at year 5. Regardless of how you do the capital allowance and the depreciation, at the end of year 5, it is going to nil off. Now, what does that mean? It means that this 400 is just a temporary difference which will be spread over the remaining 4 years. Now, if eventually, in instances where it will not eventually nil off at the end of the day, then you can now start talking of permanent difference. For example, the taxman does not know what is called a fine. The taxman does not accept fine, or does not accept fine. I'm just using that as an example. Does not accept fine as an expenses, as a deductible expenses. Meanwhile, for the accounting man, he accepts an accounting person, or from an accounting perspective, from an accounting perspective, fine will be used to reduce our our income to arrive at our profit before the tax. Now, at the end of the day, whether in year 1 or in year 50, the taxman does not allow. Which means that at the end of the day, this is a permanent difference forever. That is the difference between a permanent difference and what? And a temporary difference. A temporary difference, at the end of the day, the difference At the end of the day, the difference will reverse. That is for a temporary difference. But for a permanent difference, at the end of the day, the difference will never reverse. It is permanent. Please take note of this. Now, that's temporary difference. We're going to move a bit to the next one, which is what is taxable temporary difference, which I'm going to code as TTD. Now, take note of this. A taxable temporary difference is a difference. Now, this is where I am on the notes. Now, a taxable temporary difference is what? A temporary difference that will result in taxable amount in the future when the carrying amount of an asset is recovered, or what? Or the liability is settled. I'll take that again. Now, a taxable temporary difference is a temporary difference that will result in taxable amount. Take note. It will result in taxable amount in the future when the carrying amount of an asset is recovered or a liability is what? Is settled. Now, this is very simple. We are saying that a taxable temporary difference arises because technically, or let me just put it in a plain man language, arises because you are enjoying some tax benefit now, right? That eventually will reverse as you are using the asset compared to the accounting benefit that you've actually accounted for. Now, this will take me back to example that I used earlier, because this is a typical example of how a taxable temporary difference arises. Now, the 1-4 we have here, right? The 1-4 we have here, right, is going to reduce my taxable profit. Why do one compared to this 1,000? This is what I mean. Now, please take note of 1-4 and 1-3. Now, let's do it this way. Now, the tax man, the accounting man. This is just an example. Now, let's look at it. Profit before depreciation. We are going to have the same figure for both of them. Let's say 5,000, 5,000. Now, watch. The tax man, we look at what? We look at capital allowance. Why from an accounting perspective, you look at what? Depreciation. Now, from the question or from the short example we have up there, we said the capital allowance is what? Is 1-4. The depreciation is what? Is 1,000. Now, 500 minus 1-4 is going to give me 3,600. 5,000 minus 1,000 is going to give me 400. Now, what does this mean? From the taxman perspective, you are going to be paying a lesser. You are going to be paying a lesser tax. Yeah, that's from the taxman perspective. The tax you'll be paying in this particular year. The tax you'll be paying in this particular year is going to be like it's going to be less than the amount you'll be paying from the accounting point of view. Now, but in the future, because your accelerated capital allowance would have reduced over time. right? Your capital allowance would have reduced over time. It means that by then, let's say in the next year, your annual allowance will just be 500, like we have. Sorry, will now be 900, like we have here. Let's still use this 5,000 as an example. It will now be 5,000 minus 900. Automatically, you are going to be having higher taxable difference. Now you can see that when there's a temporary difference in this case of capital allowance and depreciation, it is going to lead to what? A taxable temporary difference, which means that in the future you are going to be paying more tax as a result of this taxable difference. Sorry, as a result of this temporary difference. Now, just carry along. Very soon along the line, I'm going to explain to you how to get the tax base of an asset, which is this tax man, and the carrying amount of an asset, which is what? Which is this accounting point of view. Just carry along. We are still trying to explain the terminologies. Now, the next thing is the deductible temporary difference. Let me still use DTD, right? Now, this is the direct opposite of taxable temporary difference. Now, let's go back to our notes. Now, a temporary difference that will result in amounts that are tax deductible in the future. Please take note. Tax deductible in the future. Taxable temporary difference is those events that arise as a result of taxable amounts that will be paid in the future. Why this is deductible amounts in the future. What does that mean? Very simple. We are saying that a taxable temporary difference, you have currently you have paid more tax as a result of enjoying lower tax benefit, right? Compared to the as a result of enjoying a lower tax benefit compared to the accounting expenses you've accounted for in your financial statement. Now, which means that in the future, it will still reverse. Don't forget, temporary difference is not a permanent difference. To see reverse. Eventually, when it reverses, it means that you are going to enjoy more tax benefits, which will eventually reduce the future tax you'll be paying. Now, that is what we mean, right? That is what we mean by deductible, because in the future, it will help you to reduce future tax. Why taxable is it will a taxable temporary difference will allow you or will make you do what? Incur more tax in the future. Now, that is just a simple definition, or a simple definition of temporary difference, taxable temporary difference, and deductible temporary difference. Now, like I said, I'm not going to be focusing on current tax in this class. So bear with me. I'm just going to omit the current tax portion, which is very, very minimal in the notes. Now, I put it here. It's just a key point that you should know. Now, I said temporary difference often mean that, right? Temporary difference often mean that there's a delay between profit being reported for accounting purposes and tax being charged on those profits. Two, they may also mean that tax is payable before profit. Sorry, tax that is payable before profit are reported for accounting purposes. Let me take that in. They may also mean that tax, okay, let's go back a bit up. Now, taxable profits are nearly always different. I'm starting from here at this point. Taxable profits are nearly always different from accounting profit. Some differences are permanent. I've explained all these. For example, fines, political donation, entertainment are normally disallowed for tax purposes. Now, these items do not give rise to deferred tax. I mentioned that initially. Taxable permanent difference does not give rise to deferred tax. Please take note of that. It does not give rise to deferred tax. Now, the next thing is some differences are temporary. For example, interest received, paid in total. Sorry, interest received and paid is normally taxed on cash basis. I mentioned that earlier that the taxman focuses on cash basis, while an accounting man focuses on what accrual basis. So please take note of that. Yeah, they may also they may also mean that tax is payable before profit. They may also mean that tax is payable before what? Before profit. Now, so in essence, what we're just trying to say here is that in real life scenario, which is what I've explained up there, a taxable temporary difference will always lead to what? We always lead to future. We always lead to future tax. Why deductible temporary difference will always lead to what? A reduction in future tax. That's what we're just trying to say in this place. And it is also worth noting that a taxable temporary difference, I already mentioned it up there that TCD is taxable temporary difference, will always lead toward deferred tax liability because you are likely going to be paying what? Tax in the future. So please take note of that. It will always lead to what? Deferred tax liability. Let me take that again. Taxable temporary difference, because it is a difference that will lead to taxable amount being paid in the future. It will lead to what? Deferred tax liability. Let me write that in full since it's the first time I am mentioning that. It will always lead to deferred tax liability. Now, the other one, which is the deductible temporary difference, this will always lead to what? The opposite of that, of deferred tax liability, which is what? Deferred tax asset. Because it is an asset, because it's going to bring about future economic benefit. It is going to bring about inflow of future economic benefit. How do we mean? Because it's actually going to reduce the tax amount that you're going to be paying in the future. Deductible. Okay. Now, that is that about that. That's what we're just trying to explain in up here. Now, it is very, very important that I mention something to you before I move to typical example of. I've also explained typical example of what leads to temporary difference. Yeah. Um, Accelerated tax allowances is just because you are getting more tax benefit, like I mentioned up here, where you have more tax benefit of 1/4, right? Capital allowance compared to the 1,000 that you have for the accounting point of view. That is a typical example of accelerated tax allowances because you are having more tax allowances in the first year, accelerated, than what you'll be having for accounting purpose. Okay. Now, before I move, and okay, yeah, this is where I want to go to directly, which is calculation of tax base. But before I move there, let's quickly look at this line. Items credited or charged directly to equity. Now, IAS states that deferred tax should be charged or credited directly to equity if the item it relates to is credited or charged directly to equity. Now, let me quickly explain that. It's very simple. What we're trying to say here is that, take for example, you have a revaluation gain, and let's assume that the revaluation gain is occurring for the first time. So you don't need to think about, oh, was there a previous revaluation loss before you take it to expenses and like. Now, let's assume that the revaluation gain is for the first year. And the revaluation gain, you've already said, debit your PPE and credit your other comprehensive income. Now, this your other comprehensive income, let's say the amount you've credited is 100, and there is a deferred tax for this purpose, deferred tax liability for this purpose, let's say 5. Now, the standard is saying that this your deferred tax, because what is leading to this deferred tax of 5 revaluation gain was credited to other comprehensive income. What should you do? You should also take this 5 to your other comprehensive income and not include it under what? Under your tax expense in your income statement. Take note. Don't take it to your tax expense under your, sorry, did I say income statement? Under your statement of profit or loss. Don't put it under your statement of P or L. Take note of that. That's what that statement just saying. Now, let's go straight to calculation of tax base and calculation of carrying amount. Let me start with carrying amount. Your carrying amount is just very simple. I need to write that in full as well. Now, carrying amount, abbreviated as CA. Now, your carrying amount is very simple. Your carrying amount is your book value. Take note of that. Your carrying amount is your book value. Now, what are we saying? It's as simple as ABC. We are saying that your carrying amount, let's say, for example, an asset. What is the book value of the asset? Now, the tax base, of an asset. Now, please take note of this. The tax base of an asset, we said the carrying amount is the book value. Now, what does the tax base? What does it mean? What is the tax base? Now, the tax base, I will now split this. Let's start with of an asset. Now, the tax base of an asset is the amount that will be deductible for tax purpose against any taxable profit that will flow to the entity when it covers the carrying amount of the asset. I'll take that again. The tax base of an asset is the amount that will be deductible for tax purpose, right, against any taxable profit that will flow to the entity when it recovers that carrying amount. Now, let me put it this way. It's simple. Assets, tax base of an asset. I will look at, when we are saying tax base of an asset, I'm just trying to look at the best way we look at this. Now, the tax base of an asset, a typical example, or I'm just looking at the best way to make this. I do not, because this is where the complexity of IAS 12 is. And I'm looking for a best way to simplify it. Now, tax base of an asset, I will categorize this into PPE and other assets. Now, the PPE, simply put, your property, plant, and equipment, your fixed assets, right? Now, I will put the tax base of my asset that is a PPE, right, is the tax written down value, TWDV. It's as simple as that. You don't need to crack your brain too much. The costs, and this is always the cost. Let me just put it. We're going to come back to that. This is always the cost of an asset, historical cost, less what? The historical cost of an asset less the capital allowance. That is your tax within that value. Very straightforward, not difficult. Now, for other assets, what is a tax base? Don't forget TB. What is a tax base of other assets? Now, when I mean other assets, let's say, for example, trade receivables, interest receivables, and the likes. Now, The tax base, if you want to calculate what the tax base is for this particular asset, don't forget, I already explained what the tax base is initially. But now I'm giving you a practical way of getting what the tax base of an asset is. Now, the tax base of an asset that is not a PPE is simple. Is the carrying amount of that asset less what? Less the amount that will be less the amount that will be taxable, right? Less the amount that will be taxable in the future. Take note of that. Now, the one of PPE, an asset that is PPE in nature, is very simple. The tax residual value, which is always what? The cost of the asset less the carrying amount. Sorry, less the capital allowance. Very, very straightforward. Now, for other assets like trade receivables, interest receivables, these receivables, and where there's a temporary difference. Now, the tax base of such assets is the carrying amount of that asset, the book value, right? Less the amount that will be what? That will be taxable in the future is an asset. Because it's an asset, which is likely going to lead to income, right? Don't forget, increase in your asset, increase in asset is an income. Now, which is likely going to lead to an income in the future. How much are you going to tax that income? For example, interest receivable. You've not received that interest. Don't forget, taxman is a cash basis, uses cash basis. Now, you've not tax, you've not received the interest. The taxman has not seen it. Now the question is, how much is what's the kind amount, the book value of that interest receivable? Out of that interest receivable, how much will the taxman tax in the future? That is what I mean by amount that will be taxable in the future. When you do that minus this, you get what? You get the tax base of that asset. Let me put here, e.g., interest receivable. That is the way to get your tax base of an asset. Pretty straightforward. By the time we get to an example that we are going to look at very, very soon, I'll be touching more on this and I'll be explaining it, what this whole tax base of an asset is and tax base of a liability. Now, let's look at tax base of liabilities. Pretty straightforward. Now, the tax base of a liability is the carrying amount of that liability, right? Less amount that will be deductible. Because in most cases, your liability leads to expenses, and expenses is what does what? What is deductible in the future. Now, the kind amount of that liability, less amount that will be what? That will be deductible in the future. It's as simple as that. Now, take for example, let's say your interest payable. How much interest are you going to pay in the future? Out of that interest, right? How much is the tax man going to allow you to deduct against your profit? It's as simple as that. That is the tax base of a liability. Now, we've looked at temporary difference. We've looked at deductible temporary difference. We've looked at taxable temporary difference. We've looked at the tax base of an asset that is PP, the tax base of an asset that is not PP, that's the other asset. Then we've looked at the tax base of a liability. Now, for ease and for summary of all this, don't forget, temporary difference leads to The difference between the tax base of an asset and the carrying amount of an asset leads to, sorry, the difference between the tax base and the carrying amount of an item leads to what? Leads to temporary difference. Now, temporary difference can either be deductible temporary difference or what? Or taxable temporary difference. Then, like I said earlier, taxable temporary difference leads to what? Deferred tax liability, while deductible temporary difference leads to what? Deferred tax asset. Now, to summarize this whole process, now, I'm going to give you a summary and the code to solving your deferred tax question in an exam situation. Now, I will start with the first one. When the carrying amount, right, of an asset is greater than the tax base of an asset, now, this automatically leads to taxable temporary difference, TTD. Carrying amount of an asset is greater than the tax base of an asset, it automatically leads to taxable temporary difference. Let me give you a scenario. We are saying that, oh, the carrying amount of an asset is 5,000 and the tax base is 4,000. The taxman is looking at it, oh, I'm going to tax you on 4K. This is just an example. I'm going to tax you on 4K. Meanwhile, the accounting man is looking at, oh, I'll be taxed based on 5K. Now, there's a temporary difference of 1K. Who is going to pay lesser tax at the moment? The tax base is going to have a lesser tax at the moment, while the carrying amount is going to have an higher tax. But in the future, eventually, both the 5K and the 4K, we are going to arrive at zero, right? Eventually, it means that in the future, I am going to be taxed more. That is why it is a what? Taxable temporary difference. I explained that earlier. I just needed to repeat that for a better understanding. Now, I go to the next one and I tell my students that it's simple. Just look at the opposite of what we've written down. Once you identify this first one, just look at the opposite. It makes life very easy for you. Now, what is the opposite of this? When the carrying amount of a liability is greater than the tax base of a liability, it automatically leads to deductible temporary difference. Deductible temporary difference. I go straight to the opposite of this. When the I go straight to the opposite of this. When the tax base, right, of an asset is greater than the carrying amount of an asset, right? When the tax base of an asset is greater than the carrying amount of an asset, automatically this is the opposite of the first one that we have here. Sorry about that. This is the opposite. Okay, let me just make it a bit easier so that it doesn't confuse you as well. Now, we've looked at the first one. The carrying amount of an asset is greater than the tax base of an asset. We said it's going to lead to what? Taxable temporary difference. Then we looked at the opposite of that, which is the carrying amount of a liability is greater than the tax base of a liability. Then we say it will be what? Deductible temporary difference. Now, we are going to look at the opposite of the first one, or okay, to make it easy, let's look at the opposite of the second one, which is the tax base which is the tax base of a liability is greater than the carrying amount of a liability. This automatically leads to what? Taxable temporary difference. And lastly, whenever the tax base, right, of an asset is greater than the tax base of a liability, right, that also leads to what? Deductible temporary difference. Take note of that. It also leads to deductible temporary difference. Now, once you understand this four things that I explained in this place, once you understand these four things that I've dropped in this place, I can tell you that an income tax question is as simple as ABC for you at that point. Now, let me take, let me add to this now so that you have an understanding, a very good understanding. Now, whenever you have taxable temporary difference, I said it earlier, it automatically leads to what? Deferred tax, what? Liability. Whenever you have deductible temporary difference, it leads to what? Deferred tax asset. Taxable temporary difference, deferred tax liability. Deductible temporary difference, deferred tax asset. It's as simple as that. I hope you understand this. We're going to look at a question shortly, right? We look at a question shortly. Look at this bit of question illustration 2. We look at that, and uh, from there we can now move to some other thing, right?